Hello friends, today we will be discussing should the company either buy call or put option to hedge company's position. Let us start. An option is a derivative, a contract that gives the buyer the right, but not the obligation, to buy or sell the underlying asset by a certain date at a specified price. There are two types of options, calls and puts. American-style options can be exercised at any time prior to their expiration. European-style options can only be exercised on the expiration date. To enter into an option contract, the buyer must pay an option premium. The two most common types of options are calls and puts. Calls give the buyer the right, but not the obligation, to buy the underlying asset at the strike price specified in the option contract. Investors buy calls when they believe the price of the underlying asset will increase and sell calls if they believe it will decrease. While puts give the buyer the right, but not the obligation, to sell the underlying asset at the strike price specified in the contract. The writer, seller, of the put option is obligated to buy the asset if the put buyer exercises their option. Investors buy puts when they believe the price of the underlying asset will decrease and sell puts if they believe it will increase. Calls and puts are primarily used by investors to hedge against risks in existing investments. It is frequently the case, for example, that an investor who owns stock buys or sells options on the stock to hedge his direct investment in the underlying asset. Hedging involves taking a position in some market that will limit or protect an investor's downside in another position or portfolio. His option investments are designed to at least partially compensate for any losses that may be incurred in the underlying asset. However, options may also be used as standalone speculative investments. If an investor believes that certain stocks in their portfolio may drop in price, but they do not wish to abandon their position for the long term, they can buy put options on the stock. If the stock does decline in price, then profits in the put options will offset losses in the actual stock. Investors commonly implement such a strategy during periods of uncertainty, such as earnings season. They may buy puts on particular stocks in their portfolio or buy index puts to protect a well-diversified portfolio. Mutual fund managers often use puts to limit the fund's downside risk exposure. Next, you should understand the required time to monitor your positions as the stock moves around. Premiums erode, volatility increases and interest rates change. You may wish to make adjustments from time to time by replacing a set of securities you are using to hedge your portfolio with a different set of securities. Then there are the decisions about whether you should buy puts, sell calls, or do a combination of the two. Finally, decide which calls are the best to sell or which puts are the best ones to buy. Options that are farther out of the money will have lower premiums, but will also provide less potential protection. As markets move, you may need to adjust your hedge and change the strike price accordingly. Thank you. Have a nice day.